Hey everybody, welcome to this free edition of our Trader User Group for the trading week ending November 3rd, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme, are we all clear? Are we ready to just go to the moon or what? Well, stand by. I want to go through everything and what I see in the markets and how they're shaping up. And actually what happened this week is normal considering what I saw. A couple of about three things really helped move the markets and give us one of the best weeks that we've had in almost a year. So let's just take a look at things and see how they're doing. You can see everybody is in the green this week. I mean, look at the Russell. They were up over 7.5%. Almost went from underwater over 7% to flat. NASDAQ, S&P, and Dow all very strong weeks as well. Solidly in the green year to date. What a week the markets make. And you can see here that I said there were three items that I think are credited really with giving the bulls a strong lift. More on that in a minute. But, one was reduced treasury issuance announced by Janet Yellen. And the bond market kind of interpret that as a sign to move rates lower. Second was a more dovish Fed. And the third was the weakening jobs report we got this past Friday. But before we get into a little bit more detail on that, you can see over here that the PE ratio is sitting at 19.42. The forward is 19.27. So for all practical purposes, fairly flat. Dividend yield 1.61% in the S&P. 10-year Treasury almost fell 50 bips in 2 weeks. This past week it was down dramatically, down to close the week out at 4.56%. Still higher than the dividend yield in the S&P by about 297 bips or almost 3%. Earnings yield is a little over 5%. Yield over Treasury is 49 bips. The real yield, taking into account inflation, is a little over 1.5, just slightly under 1.5%. And the VIX, as you can see, down almost 30% for the week, just with this big, strong upward lift, moonshot of a week from a price action perspective. The close of the prior week was 21.27. This week, 14.91. You can see the best performer for the week for the U.S. markets was real estate, almost 2.7%. Worst was energy, just slightly under 3.5%. Annual sector performance leading the way all year. Communication services 26.82, bringing up the rear pretty much all year was utilities at 25.10%. So really, as I said, one of the primary drivers was the sentiment. We had the Fed policy meeting this past Wednesday. The Fed's left the rate steady at 5.25 to 5.5%. That was pretty much expected. But they said, or Boom Powell has signaled that the recent run up in long-term Treasury yields at that meeting, they were still fairly high, achieved some of the tightening the policymakers, the Fed governors, were looking for. So that the markets interpreted that as, this would be the second meeting in a row where the rates are going to be flat. And he even hinted that probably December, assuming rates stay, fairly elevated, even though we had a big pullback, that they probably won't hike then too. And you could see the percentage probability of a rate hike in December was lowered. It was moved out to January and February. Okay, but even then, a lot of the markets are interpreting this as, well, the rates are going to be pretty much, we've hit the end game, and now it's just a matter when are they going to start cutting rates. The other thing this past Friday is a closely watched payroll report, the monthly numbers. And they came in at 150,000 jobs. I think the markets were expecting 180, so that was a little bit worse than expected. And right now we're in a bad news is good news from a price action perspective. Unemployment rate rose to 3.9%. That's the highest we've seen it since January 2022. And labor wage growth, slowing just a little bit as well. So all of these numbers, from the Treasury issuance, less than what the markets were expecting, to a more of a dovish Fed policy, to a slowing of the jobs, all these things, which is what Boom Powell is following very closely, move to bring the back end of the duration down for bond markets. And the markets love that, because anytime you do that, that reduces or increases the amount of cash that's coming in, and it tends to bring a little bit more valuation or increased valuation of PE ratios, because PE ratios tend to stand up a little bit better when interest rates are falling rather than rising. So that's kind of what we've got here along these lines. And as I said, we're going to have, I think the market's going to have a day of reckoning next year. This is just putting things off in my mind. We'll see how all this stuff kind of washes its way through the economy. And then, of course, if we look at the rest of the major markets that we follow, over in Europe, everybody was in the green. Euro stocks, FTSE, CAC 40, DAX, all solid in the green for the week. The only one in the red year to date is the FTSE, underwater, just slightly less than 0.5% at 46 basis points. We saw the Bank of England over in the UK. They held their rates at 5.25%. They're very similar to us here, and that was the second consecutive meeting that they kept the rates steady, not hiking them or lowering them. But they did warn that rates are going to stay restricted level for an extended period, much like what the Feds have said here. Meanwhile, we did see over across in the Eurozone inflation coming down to 2.9%, went below the three handle in October. That's the lowest level we've seen over in the Eurozone since 2021. We did get GDP over there. That slowed down a pretty good little bit. It contracted 10% or 10%. It contracted about 10 basis points from Q2 to Q3. So it's still showing a weak or a very weak or anemic economy over in the Eurozone. All right, so just still not very strong. And then, of course, if we go over and look at the Asian markets, you can see both Nikkei China and Hang Seng all in the green. Nikkei had a strong week. In fact, the Nikkei is just barely trailing NASDAQ for the best index of the year so far of major currency, major country indexes. BOJ, they came out, the Bank of Japan, they committed to their ultra loose monetary policy. So they're going to be putting a stimulus package of more than 110 billion US into the economy. Remember, Japan and China, the only countries right now pumping money into the economy, where the US, UK, and all of Europe through the ECB is taking money out of the economy, cutting the balance sheet. But looking at Japan, they're leaving their short-term lending rate unchanged at a minus 10 basis points, although they've basically came out this past week and they have adjusted their yield curve control framework. And they've done that 2 times now in 3 months. And I think you're going to see more of this going into Q1 of next year. And that's going to allow their interest rate to fluctuate up on their 10-year up to 1%. We haven't seen that in a long time in the 10-year Japanese government bond. Long time. Now, the surprising element there, members, we'll go into a lot more detail on this and what it's going to impact and how it's going to impact the US dollar and the bond market here in the US, but there's going to be some really good opportunities. Meanwhile, if we look at the Chinese markets, you can see both China and Hang Seng in the green for the week, but in the red year to date, right? Hang Seng is still in a correction territory. China is just a little bit under 2% at 1.89%. We did get their official manufacturing gauge. Their PMI fell below their consensus of 49.5. It came down from 50.2 in September. So that's official contraction territory. So they're just barely muddling along. China's having a hard time this year, as you can see by their year-to-date performance in their index. The other thing that we're seeing here is that new home sales across China's top 100 developers fell 27.5% in October. And it was down 29% last month, from year over year. So just ugly, ugly numbers. Meanwhile, because of real estate being such an important part of the Chinese economy, according to the S&P Global Ratings, they put a bear case scenario with China's GDP growth could slow as low as 2.9% next year as property sales fall, continue to fall and just stay, at depressed levels. Now, you may say, well, how does that affect me here? Well, remember, the Chinese consumers were big buyers of luxury goods and other goods from Germany and the US. Should they fall and falter, that's going to put more pressure on the European markets and the US markets. So that's just something that you guys need to be aware of. What I want to do is shift the screen over and let's take a look at the major indexes, and we'll look at the interest rates too, just so that you guys can see just how these markets have really had such a strong week given those three things that I mentioned earlier. So what I'm going to do is I'm going to put it on the E-mini S&P 500 futures. It'll take about 10 to 15 seconds to come up on your screen. And you're going to see here that during the course of this pullback that we've had, really kicked off in early August. You can see here that we've fallen 11.05% from peak to trough, and it really started. The peak was right around, I think it was right around end of July, and then we just made lower highs and lower lows until we take out that 44.19 area right here. There's a little bit of a resistance zone here, and we closed out the Friday at 43.78. But until we take that out, we're still in a series of lower highs and lower lows. So this is a key pivot point area here, 44.19 to call it 44.25, somewhere in that area right there. So we need to take that out. These are EMA moving averages. That's the 50 and the 200. You can see we've regained both of them. The 50 is now flat. The 200 is flat. They were both pointing slightly down, so they've now been centered. So you can see here with this MACD, let me get it back on the MACD again. You can see here that this would suggest that any move up is going to be met by a little bit of a move back. And if we do move back, then we're going to test the 50 EMA, which is around 43.45, and the 200 EMA. We could get sandwiched between these two, which is around 42.50. Okay. We're going to see if this has legs. As I've been telling all our members in June and July, prepare for a pullback in August, September. I said it could probably run through October, which is what it's done. And then I said we should see a flourish through the end of the year, November and December, with it getting weak again towards the end of this year into January. I'm still sticking to that. That's what the charts are showing me right now. And thus far, we've been pretty much right on the money with what the charts seem to be indicating. Now, we could have some anomaly come in, like an expansion of the war in the Middle East, or some other unknown variable that would affect price action. But right now, this is kind of what I'm seeing. Okay. Now, if we look at the volume here, you can see there was a ton of short interest. In fact, we've had more short interest in the markets for over a year in what we've got in this August pullback. And you could see with that move up, volume is a lot lower. Now on this chart here, I've got a purple line and a blue line. The purple line is a 5 moving average of the blue line, which is a 20-day moving average. So a 5-day versus a 20-day. And that is the average volume, average daily volume in the futures contract in this case. And you can see when the purple line moves below the blue line, then that means there's not as much conviction on any move. Now you could see typically we've been just a lot of selling has been going on really since September, right? A lot of selling. And the volume has picked up as we've been moving lower. And then you could see this last thrust that moved from about the middle of October to the end of October to round that out. You can just see that the purple line has generally been over the blue line, a lot of volume coming in. And now as we've had this really very strong V bottom right here up, you can see volume has come back down again. So I still believe that there is a lot of short covering in this rally. And the question that's going to remain is once this rally kind of slows down and catches its breath, how much new money is going to come in through the end of the year versus profit taking on this quick move? And we are in a time of year where the seasonality would suggest the markets want to be bullish, right? So we're going to see how this move plays out. So 11% from peak to trough. So that was an official correction territory. And then we moved off of it, almost like clockwork. And then, of course, if we look at the NASDAQ, which has just been on fire, right? You can see the peak to trough. Let me just see if I got it on the screen here. The peak to trough in NASDAQ was 11.97%. And then you could see we've regained. We never did go below the 200, but we've regained the 50, and we're moving up in this area here. But again, until we clear this prior pivot high of around 15,411, then we've got to be very careful. Typically, when you regain and move beyond a key pivot point, it will retest that pivot point. And then if the retest succeeds, then you can get long from that point. If that pivot point fails, you can expect it to move back to the prior pivot point or stay within the two. So we've just had a strong thrust higher. So this next week is going to be really key as to where we're going to want to go from here. Okay. Now, if we look at the Dow, you can see the peak to trough in the Dow right here was not quite a correction territory. What we're seeing in the Dow all year long is it's always a subdued move. Whatever the S&P and clearly the NASDAQ does, the Dow is less. So it's been more of where hedge money hangs out, or I'm hedging the markets a little bit in the larger Dow. So the Dow did not hit correction territory, but we have moved. We were, as you can see, in the red for over a couple of weeks in the Dow until we finally cleared and moved back into the green for good right on October or November 1st, and then we haven't looked back. You can see there's still a downward stroke on the 50 EMA, and the 200 EMA is slightly canted down. So we've got to be very careful here on this, but you can see there is a bullish divergence here on this MACD, which does seem to suggest that any pullback is not going to take out that prior pivot low. And you can see the volume here also falling as we move higher, the purple line over the blue line. So we've just got to watch this very closely here. I'll be watching this week very closely to see if we can get a normal retracement of a big move like this in any given week is anywhere from 25 to 50% roughly, or we could put the fib nodes on there and that would be a normal retracement, right? 50%. I wouldn't expect it to retrace more than 50% because we're in that seasonality period. And then of course, if we look at the Russell, guys, it was almost in bear market territory. Peak to trough this year, 18.78%. This thing started pulling back in August 1st, like the rest of the markets, and it literally moved down almost 19%, almost bear market. And then it really kicked up back over here like everybody else. It is still in the red, as you can see, but not by much. There's the 2022 closing price, still in the red, still below the 50 EMA. This cross in the 50 and the 200 tells me this is a bear market chart. That would suggest that if we do move above the 50 EMA, which is going to be resistance, we're sitting at it right now, you can move up to the 200 and the odds favor it rolling back over again. All right, so we're not out of the woods yet. All right, we had a great week. We saw interest rates pull back dramatically, which helps valuations, which helps share price. And on top of that, we got a weakening jobs numbers and reduced inflation, which the Feds love, and they stood down for the second meeting in a row. And their verbiage and the statements with Boom Boom Powell at the press conference would seem to indicate that they may stand down in December as well. And the markets are moving out in time the probability of a rate hike if there is one more. Okay. So all of that tends to give a lift to a seasonally bullish time of year anyway. And on top of that, we got a tremendous amount of shorts in the market. So they're being buying to cover. So that's what gives us these big moves, right? Members, we'll go into some individual stocks that could just be great plays through the end of this year. I mean, that's kind of what we would be looking at. And then, of course, if we come down and look at the VIX, I mean, you could see the VIX moving down dramatically, right? I mean, it's just, we were sitting in the low 20s and then it just fell off the table. Notice we're still in the yellow zone. We haven't moved back into an all clear zone just yet. And even though we've been in an all clear zone, we do not get back to much lower than this upper boundary of an all clear zone. So I do believe we're going to continue to see chop, even though seasonality, we're bullish through the end of the year. I'm expecting the markets to finish around these levels, maybe a little bit higher. But we're going to have chop between now and the end of the year. But I do see Q1 as a key hurdle rate for the markets, and we're going to get a really good insight into whether a recession is more likely than not. Right now, I give it a 30% or 40% chance, 40 to 50%, 50-50, I guess is probably a better way to say it. But the markets seem to indicate we're going to be pulling back in Q1. We may have a little bit of a run, the markets calm down, and then we pull back again. All right. So that's a little bit about what I'm seeing over the next 60 days, a little bit of a bullish element to it, seasonality, and then longer term over Q1, Q2, a little bit of a softening of price, and then next year is just going to be a choppy year. Stock pickers market, but it's not going to be one of those years where the S&P is up 10 to 15%. It's just, I don't see that happening at this point in time. If we look at the bond market, you can see we hit my target and we're bouncing strongly. And I told our members about this, and there's some great opportunities here. I haven't even adjusted, but you could see here the 2023 low. We came down right, almost right to the tick where in the middle of my support zone for the bond market. Okay, and these were the 2022 lows. And then of course, if we look at the treasury market, we look at the 10-year rates, you can see just how far down they've fallen and how fast. We hit my target time and price, a little over, I think intraday was over 5%, and then boom, we pulled all the way back. We're going to probably settle in around this level here. This is a key level right here around 4.36%. You can see there was a heads up that we're going to get that pullback with a little bit of a bearish divergence here. And you know, I was setting our members up for trading interest rates going down or bonds going higher. You know, and there are a couple of different ways to reflect that bias in different assets depending on what your favorite cup of tea is, I guess. Currency wise, well, you can see the dollar took a tumble, right? And that was not a surprise. Look at that. And it's just been coming down as rates have been coming down. Okay. I think the dollar is going to hit a little bit of a support area here, but remember, I've been wanting to jump long the euro. So when the dollar goes down, that means the euro is getting stronger. And you could see here the euro, we're in a bear market chart because the 50 is below the 200. I said I want to see the euro get over the 50 and the 200. We're still in the red year to date for the euro, but just barely because it's coming right in at the close. I want to see this thing settle in. The charts would indicate that we're probably going to pull back a little bit more in the euro. We're not done yet. And then we'll be setting up for a long-term play. Bank of Japan, I've been talking to our members about this for quite some time. I love playing the yen because it trades for a long time. This is my original target. We're kind of sitting right. We overextended, which is normal in the yen. And now we're right back up right at my target. I do believe longer term, there's a great trade here. Members, I'll review that with you Sunday evening in our weekly market watch. If we look at gold, well, obviously gold, to me, I don't see a lot more upside in gold right now. A big part of this move was the Israel-Hamas Gaza fiasco over there. That's where a lot of this money went. It wasn't a reflection of interest rates coming down, inflation coming down. It was more of a hedge against that, much like oil. But when that starts to wear off, I think this is going to slowly drip lower, at least for now. Longer term, meaning over the next 5 years, I think gold will be higher than this. But right now, I don't see it as a worthy higher probability trade. In fact, it's a little bit extended from these low points right here. It hit my target and went slightly below it, slightly in the red intraday, and then it was able to regain it. Okay. And then, of course, if we take a look at silver, silver is the same. You can see here, it hit slightly below my target, moved right back up, and we're just slightly in the red year to date for silver. So really not much there on these two. And then, of course, with energy, if we look at oil, oil is pulling back. As I said, we hit my target of around 95. if the war does not expand, which I think I give it a 60% chance it won't. I know a lot of warmongers on TV, and I think TV news is probably hoping that it would, just so that they can talk about it, as bad as that sounds, but that's how whorish TV commentators are. But I do believe that this thing will kind of settle in here. And notice we're almost between the dividing line between being in the red and being in the green year to date for oil. And if I'd have told you a war would break out in Iran and then Hezbollah could come in and they could expand in the Middle East and oil would be almost flat year to date at this point in time, you'd say that's impossible. But that's what's happened. And oil has done the impossible, like going negative briefly a few years ago. So this is kind of where I see oil right now. I do see the odds of a lower moving oil higher than the odds of a higher moving oil at this point in time. Okay. And then nat gas, it's just following our script very nicely. You can see here with nat gas, I've had our members in this trade for quite some time in an option market play, and I just see this as just a good trade this entire year. Okay, so folks, that's a little bit about a real quick summary of where I see these major markets right now at this point in time. Members, I will see you for our weekly Market Watch Sunday evening. If you're not a member, I highly encourage you to come in and check us out because we're having another bang up year. We're beating the SPX. They gets up a little over, 12, 13% year to date. We're running anywhere from 16 to 19% in our portfolio. So that's kind of what we want to do. Otherwise, members, I'll see you Sunday evening for our weekly Market Watch. Everybody else, have a great weekend. Ciao, everybody.